with Orange County, and it's Sean Ward, First Vice President at CBRE in Orange County. Come on up, Sean.
Thanks, Bart. Well, since I'm going first, I have the opportunity to set the tone for the night, so I promise to get done in under my allotted time. So it should make everybody happy. So if you look at, next slide please. Orange County, for those of you who don't know, we are located in between LA and San Diego counties. We have the 5 freeway that runs north and south. 91 freeway is the major freeway that runs west to east, and that's important because a lot of the goods that come into the ports of LA and Long Beach travel along that 91 freeway, and a lot of them end up in the North Orange County submarket. North Orange County makes up about half of our overall, a little less than half of the overall industrial base, which is 252 million square feet. Central, West, and South Orange County make up the balance, and then we have about 100 million square feet of office product as well. Next slide. So if you look at the numbers, first thing you'll notice is that manufacturing and warehousing makes up the bulk of our industrial space, and at the end of last year, our vacancy rate was 3.4%, and that was down about 15% from the prior year when we ended at 4%. And 2010 was down 25% from 2009, so we've got a very methodical eating away of available space in our market. Absorption, we had positive net absorption for all 3 sectors. Gross leasing and sales activity, very comparable in 2011 as it was in 2010. You'll notice that construction deliveries, not really much to speak of, but do expect that to change in 2012, and we are going to talk about that. And then lastly, the lease rate trend and the sale price trend. For industrial, we're now trending upward, and office, we are flat, so it's stable, which it's a significant change from 2010 when all 3 were trending downward. Next slide. So highlights from last year, our vacancy continued to decline, now at 3.6%. We had a strong second half of the year that pushed our net absorption to a positive 1.3 million square feet. Our gross leasing and sales activity had slowed since 2009, and that's a result of our reduced available supply. The bulk of our available product now is in the 10 to 30,000 square foot size range. We've had a dwindling supply of large spaces and also Class A spaces in the market. It's really logical when you think about it. In a recovering market, the best spaces tend to lease first. Average asking lease rates started to increase, and our employment level for Orange County continued to decline and did better than California and the rest of the nation. Next slide. So to look at 2 sale transactions, highlights from last year. Labeled this slide a tale of 2 buyers, and if you look at both buildings, both are located in the North Orange County submarket. Both are Class A buildings, over 150,000 square feet, 30-foot clear, ESFR. Both had about 30,000 square feet of office space. 2 significant differences, though. The La Palma building had a tenant in there. It was a leased building for 10 years. Puente building was vacant. And this may be an extreme example, but the difference in price is very apparent. $150 a square foot compared to $86 a square foot. So that really highlights the difference in activity we had in 2011 from investors compared to users. Next slide, please. These are 2 highlighted lease transactions. We've labeled this a tale of 2 asset classes. So again, the same theme, similar transactions here, both in the North Orange County submarket, roughly the same size, both had roughly the same TI package, roughly the same amount of free rent. 2 big differences. If you look, the effective rent for the non-avenue building, 52 cents triple net compared to 28 cents triple net. Reason for it, the non-avenue building is a Class A building, 30-foot clear ESFR building. The Vanguard building, Class B. It was a good Class B building, 26-foot clear, plenty of loading, but Class B nonetheless, and that really highlights the difference we had, or continue to have in our market between Class A and really everything else. Next slide. So where does that leave us now into 2012? We are expecting rental growth for industrial product. and the strongest demand to be in Class A, rising as much as 10 to 15%. Class B industrial space absorbing, but at a slower rate, with building sales outpacing leasing. Office product projected to lag, but remain stable. Resurgence of port activity is predicted for LA and Long Beach, despite the slowdown we saw last year. Continued strong appetite for acquisition from value-add and institutional investors. And then finally, spec development is back for industrial product, and that's driven by our shrinking available inventory and demand from the buyers for Class A buildings. We're starting to see a few projects planned, which will be coming out of the ground. So in summary, 2012 could look like 2005 in our marketplace: spec development, low vacancy, and increased demand. Thank you.